QuickBooks Online 2025. New vendors set up and accounts payable beginning balances. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are in our QuickBooks Online Get Great Guitars 2025 project file we set up in a prior presentation, continuing to lay down the foundation similar to putting in the infrastructure on which we can start building the building blocks of our accounting system, being of course the accounting equation, the financial transactions entered with the use of forms located in the plus or new button, broken out by cycle, the foundation items found under the cog, generally the lists of the chart of accounts and the product and service list being the main two. We've been thinking about having our prior accounting system balances we are pulling in, adding to the chart of accounts as we do so. These are those prior account balances, which we are imagining happened as of the end of 12/31/2024. That's when we're running the report we imagined. And we now want to enter these beginning balances in our system, but instead of doing one big journal entry, we're doing them one at a time so we can take care of the specific needs for specific accounts. The most complicated one being the inventory. If we track it internally, then the accounts receivable. Now we have a similar kind of situation to the accounts receivable with the accounts payable. So now we're going to jump down here to the accounts payable. Noting that we're kind of going in the order of complications, accounts payable being the next most complicated one because it also needs a subsidiary ledger. Now note that if you are a bookkeeper and you're thinking about doing bookkeeping for clients, the setup process is often one of the most complicated things, and it's also one of the things that you can get paid more if you're good at doing it, because many clients will have messed up books. And the best thing to do is to just fix it, basically going forward, possibly starting a new company file altogether and trying to get the new information in the new company file and get rid of all the junk that is in the prior file. However, if you're a small business, you might not be dealing with accounts payable as much as possibly accounts receivable due to the fact to just the structure of small businesses, because small businesses will have to track accounts receivable, not dependent on whether they want to be on an accrual or cash-based system, but rather based on what industry they are in. If they are in an industry where they have to do the work first, bill the client, even if they're a small business, they'll have to track the accounts receivable. That's just the nature of the beast, the nature of the business. But with accounts payable, it's a little bit different because usually small businesses of most types of industries will pay off their accounts payable as it becomes due, even if they're tight on cash with a credit card. So they'll usually be using bank feeds. That's where we can maximize the automation of our accounting system with the help and use of bank feeds, usually by making all the outflows of cash connected to the bank, recording them with the bank feeds with an expense type of form. So when does accounts payable come into play? Usually for larger businesses that want to maximize their cash flow by paying as late as possible. Why don't small businesses want to do that? Well, if you're only paying a $75 bill and you can pay it today or you can pay it 15 days from today, doesn't really matter, even though there is inflation, even though there are cash flow concerns because of the dollar amount and the rapidity of the transaction. But if you have thousands of transactions at $75,000 or $7,500 even, then it's going to become more important to try to push that money out to a later point as best you can. So even if you could push it out a day later or even minutes later, like if you're credit card companies, that can significantly impact the time value of money due to inflation, as well as your cash flow, because you're holding on to your cash for longer periods of time. So that's just something to keep in mind. As a business gets bigger, that's usually when the accounts payable, tracking it very closely, and it becomes more important than the rapidity or the rapidness of just paying things as they become due with the connection of the bank feed and electronic transfers. All right, that being said, the process, if we have accounts payable, is similar to accounts receivable. We can't just enter the $15,000 as a journal entry because QuickBooks will force us to add the vendor, because we need to track the information not only by general ledger account, by detail or date of transaction, but also by who we owe the money to, so we can sort out who we owe the money to and pay those people. So that means if I go into QuickBooks here, we're going to say that we're going to be in the expenses tab, which is kind of like the vendor center. And then we have the vendors over here. Keep track of who you owe. We don't have any set up yet. Normally, we will enter vendors as we enter transactions. Those transactions typically being the expense form, the check forms if you're still writing checks, and the bill forms, typically expense forms for new businesses, and typically through the bank feeds, meaning we wait till they clear the bank with an electronic transfer, and then we add the vendor from the memo of the bank feed, which we'll see later when we get to the bank feed situation, which you want to make sure you do because it might not be required to record it, but gives you added information. So you want to kind of do that, and you can add the vendors on the fly as we go. But if we're starting a new company file, we might want to put the vendors in first. Now, like with the accounts receivable, our relationship with our vendors will be dependent upon the type of company that we have. Most vendors, we don't really care much about them, right? I don't care about Edison, the people that give me my electricity. Just give me the electricity, tell me how much I owe you, and then I'll pay you, right? I need to know your name so I can write it on the check, or need to know where to send the money to. That's all I really care about for the telephone bill, the electric bill, most bills, right? But there could be some vendors which we want to build a better relationship with, possibly those that we have repeat business with, such as people we buy inventory from, in which case, or if we're doing long contracting jobs or something like that, then we might want a lot more contact information in a similar way as with the accounts receivable if we have long-term clients that we're doing repeat business for in like a CPA firm or something like that. So just something to keep in mind. Usually, we don't need much information about the vendors. So if I am therefore exporting a vendor list from a prior accounting system and then putting them into the current accounting system, I probably want to trim down that vendor list a lot. Like I don't want to import 3,000 vendors just because that was in the prior accounting system. If I'm starting a new accounting system, the point is, part of the advantage is that you can trim down all that garbage that you don't need because you're not doing business with most of those vendors anymore, and start over on the vendor list, which means that you might want to look through the list and at least trim it down. Or possibly you don't add those vendors at all and you just simply add the vendors as you do new transactions, and then just add them as you enter the bank feeds. By doing that, then you're going to come up with a more relevant and current vendor list. You won't have this massively long vendor list. So just a quick note, your options are you export the vendor list from the prior accounting system, or you could import the vendor list just as you start a new QuickBooks file, try to import it from the desktop version or something like that, in which case you're going to have all the garbage and all the good stuff so that you can run comparative reports. Or you can do like what we're doing. We start a new company file, enter the beginning balances, in which case your option is still export all the vendors from the prior system into Excel and import them into QuickBooks. But that's possibly not what you want to do because that's going to be a lot of vendors that you might not need. So at the least, you want to go through that list, trim it down in Excel to the ones that you think are relevant, and then import those into QuickBooks so that you have a slimmer list of vendors, making it easier to do data input going forward. Or you can do, in essence, as we're doing here, only enter those vendors that actually have a balance in accounts payable, because you need to in order to get the balance correct. If you don't have anything in accounts payable, you don't need to add the vendors at all, and instead simply add the vendors as you enter transactions, typically through the bank feeds for most small businesses, so that your current vendor list ties out to the most recent transactions, which will be somewhat of a pain as you do the first couple months of data inputs when you have to basically memorize those transactions, but will make it much easier after you've done those first couple months of transactions. Okay, so that said, we could do a similar process here and import the vendors, but I'm just going to add them one at a time here because I'm going to imagine we only have one vendor that makes up this balance that is outstanding. So I'm going to go and say we could import the vendors. Just to note, if we imported the vendors, it would look like this. CSV file. We can download the sample file like we saw before, and then simply take our vendor list and then copy and paste them into the same columns. That's the way I would recommend doing it. So you have these exact same headers that they recommend, making it as easy to upload as possible. Noting and remembering, you might have to do some Excel tricks to basically break out, for example, the city, the street, zips, California, whatever, the state. If it's all in one cell versus multiple cells, you can look up different tricks to do that online. A lot of people out there teaching that kind of information, which is wonderful. All right, so let's close this back out again. I'm going to add just one at a time, though. I'm just going to add a vendor, and let's go through this. So the company name, notice that's not even required, but I'm going to put it here. It's Epiphone. This is going to be one of the people we imagine we buy guitars from. The only required field is the name here. And so you have to have that to add the vendor. Note, however, that sometimes if you're using bank feeds, you can actually pay the bank feed without having a vendor because you can choose the account. So as long as you have the account, that's all you need to record something if it's already been recorded by the bank through the bank feeds. But you want to take the memo and add the vendor, because although that won't change the financial statement reporting, it does give you another field to double check if you want to check, did you actually pay this person, right? I want to look up the vendor list to see if I paid them. Otherwise, you're going to have to look into the account, the chart of accounts, like the telephone expense, instead of going to Verizon, the telephone company that you paid, if you have a problem with that particular company or you want to run a report on it. Title, first name, these are not required. Email, again, it would be some people we might need an email from if we do repeat business with them, but most vendors we probably don't care, right? Which is like, just how do I have to pay you? Here's the money, give me my phone service, and that's all I want. That's all the contact I really want to have with a lot of the vendors. But if you're dealing, like I say, with inventory, people you do repeat business with on a personal basis, then of course you might want more personal information. Same with the address down here. Oftentimes don't need it, but might want it in some circumstances. Same with the notes situation. So the bank account number for certain types. I mean, if you're doing electronic transfers and whatnot, but oftentimes you can connect to the bank feeds and you might be connecting that way. Additional information, so business ID. So this is an important field because in the United States, we have an income tax system, which means that on the federal tax side of things, they get most of their money by taking it from an income tax situation. And so it's important, it's useful just to imagine how that works. A lot of times we learn this stuff just by rogue. We just learn the rules, but we have no idea why it works that way, which means we don't really see how things fit together, which means we can't really be flexible when things change because we don't really understand why it's happening. That's why I always kind of try to reiterate, what are we doing here with the 1099s? Let's just not just go through the motions, but actually kind of understand it a little bit, because what's happening here is the government's going to say, I want money from people that earn revenue. We earn revenue as a business of Get Great Guitars, which we're going to have to report to the government with an income statement in the form of a tax return, either on a Schedule C or other tax return based on the type of business we are, sole proprietorship, partnership, S corporation, and so on. What if we pay somebody else money? Well, to us, that's an expense, which is bad for the government, good for us. That lowers our net income, and therefore it's going to be a benefit to us. So on the government side of things, they're going to say, hey, look, I want to know who you paid the money to, because to them, it is income, right? So the government has leverage over us. How do they have leverage over us? Because we want the expense when we pay someone, either as an employee or even as a contractor. So that means, so they're going to say, well, if you want the expense, then you have to rat out who you paid the money to. Why? Because if we're going to allow you to reduce your income and get less money from you, we want to go after the other guy that you gave the money to because it's income on their side. Okay, well, how do they do that? Well, they're going to try to force us to make them an employee, because if they're an employee, they not only can force us to rat out the other guy, but they can also force us to actually withhold the money from the other guy before the other guy even gets the money. So that's where they have the most control, right? So we have that situation. Or if we don't have that situation, maybe we're paying them and they're a business. Now, if they're a big business, the government's not as concerned with them. If I'm paying the utility company, they're not concerned. Why? Because they already have their hooks in the utility company. The utility company is so intertwined with the business, it's almost like crony capitalism, right? They know the utility company is gonna report their income the way they want it, because they're kind of conjoined at the hip at this point, right? It's the small businesses that they want. So it's the small businesses that aren't corporations, that aren't employees, that they want at least a 1099 for them, because they might fly under the radar and the government's going to say, no, you have to pay us money. So that means that we have to sort out the people that are not corporations, not employees, that we're paying out money to, so that we can track the 1099, so that we can give those to the government at the end of the year, so that we can rat them out. Why? Because if we don't, the government comes after us. So that means we got to kind of go through our list of who we pay and make sure we're properly tracking the 1099s and reporting that. Usually a fairly easy thing to do, but it's always kind of a pain to do, and we want to make sure that we have the information to do that, noting that if you take on someone as a contractor, that means you have to give them the information so the government can go after them. That means you need their ID number, either Social Security, but hopefully they have an EIN number, which they could have even if they don't have any employees, because they're not going to want to give you a Social Security number. And you need their address, right? That's what the government needs to go after them. They need to know who they are, name. They need to know them by number, because that's how the government sees people. And they need to know where they live, right? And so that's what. All right. So then we have the expense rate, payment terms. So we could put the payment terms, usually not as important on the vendor side of things, because when we enter a bill into the system, we're going to have to enter the due date that's on the bill. Whereas on the invoice, the payment terms are important, because when we bill a customer, we're going to determine when we want to get paid, 15 days, 30 days, and so on. When we get a bill, we're not the one that determines that, really, right? It's them that determine that. So we're going to have to enter the due date. So that's usually not as useful. Account default expense category. So we could choose the expense category that is the default when we have this particular vendor, but oftentimes that's something that's going to be kind of memorized as you enter transactions. So I don't think most people really use that. And then the opening balance. Now, you will only want to use the opening balance when you're doing what we're doing here, adding the opening balances into the system. Otherwise, you never want to use the opening balances, because you're going to be paying them as you're paying the vendor. So only the one time would you enter this kind of opening balances, which happens to be this time. So I'm going to then say, what was our balance that we need? 15,000. I want to make sure it's as of the prior period, 12/31/24. So now what's QuickBooks going to do with that opening balance? It's going to have to impact at least two accounts, because that's how the double entry accounting system works. That means that we owe Epiphone, which means it's a liability, which means you would expect it would increase the accounts payable and then have the subledger of who we owe it to, Epiphone. The other side, where's it going to go? Well, it's probably going to, what kind of form is it going to use? It's probably going to use a bill form, because the bill form is the form QuickBooks uses in order to record the transaction for us increasing accounts payable. Usually it puts the other side to an expense then. So it's probably going to go to an expense. We want it to go to equity. But as long as it's recorded last year, it'll still roll in or close out to equity. So that's the idea. Let's save it, close it, see if it does what we think it should be doing, dude. All right, let's close up the ham boogie. And so now if I go into my vendors, then it's added the vendor. So there we have Epiphone. So let's just go into it one more time. If I went into like the expenses, and then I close the ham boogie, and then there's the vendor that we added. There's the balance, of course. If we go into that vendor, we see the detail of the accounts payable. They entered it with a bill, as was expected, right? So that means that if I look at that bill, it's not going to have all of the information possibly similarly to the invoice that we did as we entered in our prior accounting system if there's a lot of detail in the bill, but it at least gives us the bare bones of a bill, right? It might not even be going to the right expense account, right? That's okay, but it gives us the bare bones of the bill so that when we pay the bill, we can connect the bill payment to the bill. Let's see what happens to the actual financial statements over here. We're going to go down and say reports on the left-hand side. We're in the standard tab. Right-click on the balance sheet to open a link in a new tab. Right-click the P&L to open a link in a new tab. Let's see, que paso, what happened to the financial statements. Closing up the ham boogie. Let's change the range going from 010124 to 123124. So we entered it as of December 2024. Accounts payable went up. That looks good. The other side probably went to the income statement because it entered a bill. So let's go to the income statement, close up the ham boogie, range change, 010124 tab, 123124 tab, run it to refresh it. And so there it is. They put it into miscellaneous expense. Now, is that where it should have gone? Most likely, that's not where we put it originally, most likely, because when we entered the bill last year or whenever we entered it, looks like we paid Epiphone, which is who we buy inventory from, which means we probably increased inventory when we entered the bill. Does that mean I should go in here and adjust it, recording it to inventory? No. Why? Because we already entered the inventory balance, right? All I really want to do right now is get the beginning balances correct, get the subledgers correct, allow it to be entered with some kind of bill, even though it's a generic bill, so that when I pay the bill, it'll connect the bill to the pay bill. I don't care that it's going to the wrong expense account because that happened last year. If I want to know the expense account that it went to, then I can look at the transaction that was entered last year because the cutoff date, remember, is 12/31/2024. All I want to do is get the beginning balances correct as of 12/31/2024 and have as easy a time going forward as possible. The accounts payable straddles between 24 and 25, right? Because it was entered in 2024, but it's going to still have something that's connected to it in 2025. So that means I have to put it in place as of the cutoff, 12/31/24, because it has a balance sheet component. And that means if it's entered this way, I can connect it to the bill payment, which means I'm good going forward. I don't have to worry about the inventory because I'm already done the inventory a different way, entering the beginning balance for each system, allowing me to do the subledgers for each system. If I want to know the detail about the bill, I'd have to go into the prior accounting system to see when I entered the bill. You see how this is going to work? So there's kind of a straddling period where you possibly you'd want to run the two systems parallel until hopefully you've paid all the outstanding bills and outstanding invoices so that you can basically see the detail or at least print out that information right into your system so you have the detail of the outstanding bills and whatnot if there's a question about it. That's going to be the general idea. Now, if I go into this accounts payable, then what did it enter? It entered a bill. Beautiful. Let's go into the bill. What does it look like? It looks like a bill form which increases accounts payable. And then the other side, they jumped into other miscellaneous expense. That's not where we put it originally, but that's cool. We can see what happened. They entered the bill. So all we have to do now is pay the bill. And as long as we're paying it to the right person, it should work going forward perfectly. Let's go back. And then the other side is on the income statement. If I go into the income statement, into the other miscellaneous expense, there's the amount of the bill there. All right. Let's go back now. Is it a problem that they entered it into the income statement? It would be if we were going to have to run the income statement as of 2024 here, but we're not going to because 2024 is the prior period. When we get to 2025, there's not going to be anything in the income statement because the income statement resets like an odometer if we were to drive a day and then reset it to see how far we're going to drive in the next day. We reset it. So I can reset this bad doggy by going 010125 to 123125, run it, nothing's there. Perfecto, just like my friend Mundo, who's a perfectionist, does things because he says he's So over here we have net income, 5,500. That is going to roll into retained earnings when we get into the current period. Let's check it out, see if that is indeed the case. 010125, 123125, run it to refresh it. And so now it should be in retained earnings. That's where we want it to be. So our idea is working, which is that we're entering all of our beginning balances one at a time, the other side going to equity in some way, shape, or form, whether that be going to opening balance equity, retained earnings directly, or to the income statement, which will roll into retained earnings as of the cutoff date, so that I have nothing in the income statement in the current period we're going to start working on, and then we'll adjust the equity section at the end of that to make sure we're in the proper equity account. So that looks good. So now we have our accounts payable, and we have a subledger for accounts payable, which only has one item in it, which I don't really need to run the report for it because you can see it internally here in the expenses. And we can see, of course, if I go into vendors, we have the one vendor. If we break it out by who we owe the money to, 15,000 going to the Epiphone. So the accounts payable is similar to accounts receivable in that QuickBooks will force the subledger to work by not allowing us to post something to accounts payable without adding a vendor. So in other words, even if I tried to enter this with a journal entry, then it wouldn't let me enter the journal entry unless I entered the vendor. We could have done it that way. So you could try to say, I should just do one big journal entry. That's what you would do if you were a book problem person, right? Someone that learned accounting from the textbook. You'd say, why don't I enter this big journal entry? And then you could still add the vendor to it, but it's going to look ugly internally, right, for the bookkeeper. Because then if I go into here and I look at it by vendor, it's going to show the detail here not as a bill but as a journal entry. Now that's going to be a problem, because then when I pay the bill, usually I pay the bill by connecting it to a bill pay form. So if I don't have it in there as a bill, but rather as a journal entry, it's going to mess up the payment of it. Now, I think you could still do it. Like, I think you could still kind of connect a journal entry to the payment, but why do that? We don't want to do that. We want it to look normal in our accounting system as a bill, that we can now easily go forward and pay the bill like we normally would, connecting the bill payment to the bill, which will make the detail of Epiphone's detail here look normal. By the way, this detail is the other thing that you kind of lose if you do this way, right? So if you add all the vendors into the current system, you're going to lose like a lot of the detail for all of the past transactions of that particular vendor, which you would have in the prior accounting system, which if you're going to lose a subscription to it or something, you might want to print that detail out just so that you have the information for it. But it's kind of nice at the same time, because now you have a nice clean system going forward. So we're going to say if it's prior to that accounting system, I have to look in the prior accounting system in some way, shape, or form. If it's after the cutoff date, then it's going to be in this current accounting system. That's where we're drawing the line. That's the idea.